the cogs of the market start to crank up for 2025, there is a lot going on in financial markets. I wanted to take some time today to talk to you about some of the developments we're taking place before Blake and I can get back together on the 31st of January. But whether we're looking at the sell-off in bond markets, the dollar strength we're seeing, Trump's first 100 days, which starts on the 20th of January, US earnings coming through, US economics, Fed policy, RBA policy, China markets, whatever you're talking about, there's a lot going on. I wanted to cover it with you today. This is the trade-off. Well, hi there. My name's Chris Weston, Head of Research here at Pepperstone. Blake and I will be joined together on the 31st of January, but because there's so much going on in financial markets as the wheels of the financial markets crank up and people get back to their desks, people get back to the screens and have a look at what's been going on, I thought I'd take some time today to really have a look at what we're seeing across the macro thematics, some of the price action, some of the charts that we're seeing, and get set really for what is a big January already and what will become an even bigger January as well. So let's go into some of those thoughts. Let's go into Topical Thunder. Okay. Right, I just thought we'd touch base with some of the key points that we've got at the moment. You can see bonds, Fed policy, Trump, US earnings. There's obviously a lot more going on than that. We can talk about China markets, RBA policy, Bank of Japan policy. There's all these other factors that are playing in the moment. But certainly the question that we're getting more and more at the moment is what's happening with the US bond market and developed market bonds more prominently. And should we be more concerned? When are we going to see the level of and the rate of change in various bond markets, which is going to cause more significant stress and maybe a result from a central banker? I think first of all, if we have a look at really the point which is really on front of mind is what's happening in the US Treasury market. You know, we have seen yields on the 10-year, if we look at the longer end, and certainly the 30-year Treasury has been even more aggressive in selling off. But we've seen the 10-year trade from around 3.59 up to where we are at the moment, about 4.68%. And obviously people are concerned that perhaps we get to 5%. And could that be the point where equity risk really starts to sell off and duration assets really start to move lower? Now, there are a number of reasons. I think it's the why. Why are we seeing this? I think it's absolutely key. And I think in that situation, you've got to look at, firstly, where is the terminal pricing for the Fed implied from the markets? And that's gone from around 2.7% for terminal Fed pricing in September to around 4%. So certainly that low point to the trough of the cycle has moved up, and I think that's pushed up. The other factor is that we have seen a significant amount of issuance and supply coming through into the market. And because the Fed are obviously not buying bonds anymore, in fact, they're doing QT, the private sector are obviously asked to buy those bonds. And that increased supply that's coming through means that the private sector are demanding high yield. So I think supply is really one of the big dominant factors. Now, we are seeing inflation moving up as well, and that's a bit of a concern for markets. And I certainly think that needs to be pushed up. And of course, term premium has been pushing up as well. So I think in this situation, when we're also looking at the Treasury Department that needs to roll over $3 trillion worth of T-bills this year, and some sort of speculation that perhaps they may go into more longer term coupon issuance, which again increases the supply further out the curve. And you have seen 10-year Treasuries and steepening of the curve coming through, and that's now starting to cause some anxiety in markets. If we look at the reaction that we saw earlier in the week from the ISM services number and also the jolts, which came in better, we saw yields moving up on the back of that, and equities fell. And I think this is the first time now we're starting to see good news resulting in bad moves in equities. In the UK, I think it's a really interesting one as well, because that's really started coming to prominence now. People are asking, this move that we've been seeing in the 10-year up into 4.79, which, as you can see from the chart, is really accelerating. Are we going to see another mini budget too, a Truss Kwasang type situation playing through? Now, the UK are in a bit of a pickle. You know, they've got low growth. The Bank of England will probably cut rates in the next meeting on the 6th of February, but certainly in an environment of sticky inflation and low growth, and with bond markets moving up as people look at additional supply coming through from the gilt issuance, I think that's a toxic mix, and we are seeing that the pound trading down to 123.64. The higher that yield goes through 5%, the market will not like that, and the pound will keep dropping. But it's also, you're seeing the German Bund trading from 2% to 2.54. So this is a global sell-off. But I certainly think we do need to keep our eyes on what's happening in duration and the bond market. And I think the magical number everyone's talking about is 5%, but it's the why we've seen the selling. And for me, that's mostly a supply issue, the private sector being asked to take down more supply. And with inflation expectations moving up, I think this is something that absolutely needs to be front of mind. Let's have a look at Fed policy because, of course, this is a very dominant situation. The Fed will meet later this month, and as it stands at the moment, the market's giving very little credence that we're going to get a rate cut there. So the Fed will be on pause in the January meeting. In fact, if we go further out for the curve throughout this year, if you have a look at SOFR futures for this year, you are seeing a situation where the market is pricing about 35 basis points of cuts. Is that too low? Are we only going to see one, maybe two cuts? The market's sort of pricing 1.5 rate cuts by the end of the year. We just obviously don't know. The forecasting that far out is obviously a hard thing to do, and no one really likes to do it. But the market is pricing 35 basis points of cuts. And again, that's supportive of the US dollar. It's another factor that's been pushed up the terminal rate and has seen yields moving up as well. So the question now is what happens to the data? The Fed are a slave to data. The market will be a slave to data as well. And I think in that situation, obviously, we're saying this now ahead of non-farm payrolls numbers that come out tomorrow. The market is expecting 165,000 jobs to be created. I think anything above 200,000 will be another dollar positive and lead to rate prices coming out. We'll probably get to about 30 basis points. And of course, we're having a look at the unemployment rate as well. So that's going to be a big factor. I think the market's going to be very sensitive to that as well. But look, the US economy continues to be the exceptional story at this point. We're seeing growth from the Atlanta Fed GDP tracking mechanism sort of running around 2.68%, which is still pretty healthy when you compare it to the UK, certainly Europe, China, which is still a lot of conjecture around what's happening in that. We're seeing Australian growth really buoyed up by fiscal spending and government spending rather than what's happening in the private sector. And so I think, we'll still continue to watch that. And I think the next one, next week, we're going to get US CPI numbers. So that's going to be a really important situation. A lot of the sell-side economists are expecting 3 rate cuts for this year. Obviously the market is underpricing that. So if that was to come to fruition, maybe we got some downside in the US dollar. But right now, in a situation while yield spreads are widening out against the US dollar, certainly in the pound, it's the why that's causing, and I think it's for bad reasons. So again, we're sort of taking a reasonably positive stance. I think if we're sort of taking away from the Fed, and what's happening with the data and how that feeds into Fed policy, I also think you need to have a look at the Bank of Japan. The Bank of Japan will be meeting in January later this month, and the market is putting a 50-50 outcome whether they hike rates. So that's something that could cause the yen to move. And certainly if you look at dollar yen at the moment, we are just breaking out top side of that recent consolidation zone, and I think we probably trade into 159 into 160. I think RBA policies are really interesting as well. Next week we've got the employment data coming through. Labour markets have been very strong, but on the 29th of January, then we've got the next CPI print. And that could solidify the market's anticipation that the RBA will be the next central bank to start cutting. The market is pricing a 75% chance that the RBA cut rates at their next meeting on the 18th of February. So that's something that will be very interesting. But if you're looking at the Aussie dollar, if you're trading the Aussie dollar, we are trading a bit of a range at the moment of 62.50 down to 61.85. That consolidation's being well traded by clients, but I think the key mechanism now is around that Q4 CPI number that comes out on the 29th of January. As I say, if that opens the door fully to the market saying we've got complete confidence that the RBA cut rates, and maybe the 70 odd basis points of cuts that are being priced out the curve by the end of the year is probably still a little bit shallow, then I think that obviously opens the downside to a consolidation break to the lows. The other factor, of course, is what's happening in the dollar renminbi, dollar CNH. That's a big driver there as well. So what we've seen is the PBOC have been sort of saying that they're okay with a slight depreciation of the yuan, but I think if we got dollar CNH through 736.50, I think then that would take Aussie dollar down through those ranges and heading perhaps even down to 60 cents over time. So do keep an eye on dollar CNH. If it was to break topside and continue to run and kick, then I think that would take the Aussie dollar down as well. So that's something we are watching in terms of RBA policy. But the market at this stage, ahead of the employment data and ahead of the CPI number, is certainly of the belief that the RBA are probably likely to cut rates at this stage. Let's go into Trump, because of course that is going to bring the noise. Mr. Trump comes into power on the 20th of January. Inauguration starts. We get the first 100 days. Obviously, we know a lot about what's been happening. He's been making lots of situations very well known on Truth Social. But I think what the first point of call is he's going to come in and obviously look to push executive orders through immigration. Immigration is going to be the first thing. To deport 11 million people from the US is going to cost an incredible, huge amount of money, but certainly there's going to be other factors that are going to play through in the short term. So I think immigration is something that is going to be a big macro issue going forward in terms of, certainly on the deportation side. And I think that may be less of a market story, but it could feed into economics in terms of labour market shortages and various factors going forward. I think where we are looking very much more prevalently, which could cause some volatility in markets. And I think, this is why you'd be looking at gold, for example, and why we could kick higher in gold as a hedge against what we could see in tariffs and tariff retaliation. I think gold could be an interesting place. The dollar should benefit in that situation. And we would expect to see the VIX trading north of 20%. But I think tariffs are going to come in. They're going to come in quite quickly. And that's well priced into markets. We've all known what Donald Trump's been saying about Mexico, Canada, China, Europe, all these other factors that are taking place. It's all discounted into markets. What I don't think is discounted into markets is retaliation. Now, I think everyone expects the countries that are going to be having these tariffs to come back. I mean, of course, they're just not going to take it and absorb that without any kind of rebuttal. And the issue now is what will that rebuttal look like? What will they come back at? And now, I think what we saw from the Canadians earlier in this week, where they said, look, we are going to potentially preempt and send a list of US goods to the market to tell people which US goods we're going to tariff in response to upcoming US tariffs. Now, that was a punchy and very hawkish message, but it tells me that a lot of these countries, Mexico, perhaps not Mexico to an extent, because we think that there probably will be a deal there, but certainly Canada, Europe, China, it's really going to be about what their retaliation looks like. It's not just about offsetting through currency weakness. What tariffs will they come back at? And I think that could implies the idea of a tit-for-tat type battle. And I don't think that's priced into markets. So a tit-for-tat pronounced battle within the media and in the headlines, I think could cause some anxiety in markets. And as markets distribution of thoughts and outcomes change and people get a bit more concerned about their ability to price risk, that's where we see volatility. So Trump's first 100 days is going to be very interesting indeed. You want maybe for people who understand what's happening in terms of trying to get a signal from the noise. But I think, the idea for me is that tariffs are going to come in from day one. Executive orders are going to be put through. But it's the retaliation. What does that look like? How pronounced? How pointy? And what kind of could this be? Much more aggressive than what's being priced in. Let's have a look at earnings, because I think if you look at the S&P at the moment, we are holding in pretty well. I mean, if S&P futures have been trading a high of 6,100, we traded down to sort of 58.79. 58.29, and I think they're below that point. Then you've got the low end of the range that we recently traded down to 5800. So that 6100. 5800 has been really the predefined range in the S&P futures for some time, and I'm using that as my guide for risk. Which way do we break over the course of January? I think is going to be something that's really interesting. Now, earnings are going to be coming through really from the 15th of January. JP Morgan and the banks, Citigroup and the banks start reporting then, and the banks will be probably quite a good litmus test about customer demand, customer credit, how default rates are looking and various factors and how their balance sheet's looking. And I think that could be quite an interesting one, as well as the regional banks, which of course are so sensitive to what we've been seeing in the backup in yields and the cost of capital and various factors. So I think the banks get us off, and then when we start going into the Mag 7 plays later in the month, I think that's going to be an interesting situation. But the market is expecting 12% EPS growth as a group for this quarter, year on year. That has come down a little bit in the last couple of weeks or so. People have massaged those expectations down as a few companies have pre-guided and they've disappointed a little bit there. But I think the earnings season's a really interesting one. Whether you're a stock trader, whether you're a CFD trader, whether you're an index trader, and you want to understand how this goes through, this is a chance for the market to understand how these businesses are tracking real-time, mark-to-market, relative to consensus expectations. But more importantly, what is the guidance going to look like? What is the outlook going to be? I mean, companies can give the visibility, given that tariffs are coming in, given that we're going to get deregulation, going to potentially get tax cuts, all of these factors. And if a company can give the visibility and a defined outlook, like we're probably going to get from NVIDIA, for example, they will be rewarded by the street. Those companies that usually give guidance but are going to refrain because of the lack of visibility under this new administration and how this all looks going forward, I think those companies may get impacted by the market. But certainly if we're looking at earnings growth, you go to the banks. The banks are expected to see 39% EPS growth, and of course they did very nicely last year. We're going to see consumer service numbers, earnings coming through. It's really energy where you're seeing the earnings declines coming through with consensus views that they're going to drop about 20%. On the revenue side, of course, it's all about tech at the moment, and those Mag 7 plays specifically are expected to see about 20% EPS growth. So the question there is, what would the outlooks be What will the guidance be about these, about how their operating environment will be? The companies which are upbeat in this environment will certainly please the market. So we are going to see high volatility at individual level. We always do, and I think earnings this time really will matter. Will we meet those year-end targets going forward? The other factor which I haven't put down here, I think, which is a really frustrating one, and that's the debt ceiling. We know that the debt ceiling was reinstated on the 2nd of February. We understand that the extraordinary measures, the cash measures that they have, will be to avoid default. Will be start to be drawn down from the 14th of January onwards. And I think, whilst we all know the outcome of what this will be, we all know that there'll be a last-minute reprieve from both parties, a bipartisan situation to push the debt ceiling out further down the line. But as we draw down some of those extraordinary measures, we are going to be looking at short-term bills and some of these short-term money markets and start to see fragility playing through and spiking people through in there. And as close as we get to that end point, that X date, so to speak, where they no longer have any more money and they'll technically default, you could see some anxiety spill out into the equity markets and to the dollar and into volatility markets. It's a frustrating one because we know how this ends, but we could get to that brink and look over the edge, and and that could also result in potentially a credit rating downgrade as well. So a lot going on through the month of January, as I say. I wouldn't be surprised if we saw the VIX trade up above 20%. I wouldn't be surprised if the dollar continues to break higher against the Swiss franc and against the yen, and potentially Aussie dollar break down through that 60 through that low end of the range I talked about, driven by a higher dollar CNH. I wouldn't be surprised if we saw equities draw down and pull back into earnings season. But there's a lot going on. I thought I'd give a touch break. I want to say Happy New Year to everyone out there. On behalf of Blake as well, I want to say Happy New Year. And we'll be back, Blake and I, for more of the trade-off on the 31st of January.